This is a demonstration of exercise 19.6b. Listed below are items that are commonly accounted for differently for financial reporting purposes than they are for tax purposes. The instructions tell us for each item below indicate whether it 1. Involves a temporary difference that will result in future deductible amounts and therefore will usually give rise to a deferred income tax asset, or 2. A temporary difference that will result in future taxable amounts and therefore will usually give rise to a deferred tax liability, or 3. A permanent difference. So we're going to use the numbers 1, 2, and 3 to determine whether these are going to give rise to a deferred tax asset, deferred tax liability, or a permanent difference. So A states for some assets, straight line depreciation is used for tax purposes, while double declining balance method is used for financial reporting purposes. So in this case, we would have a future deductible amount because we are using a accelerated depreciation method for financial reporting purposes. So that would be 1, a deferred tax asset. The next one states in B, warranty expenses are accrued when the sale is made but cannot be deducted until the work is actually performed. So this will also result in a deferred tax asset because those warranty expenses will be deductible in the future. So that would also be 1. C states the company uses the percentage of completion method to record revenue on long-term construction contracts for financial reporting purposes, but the completed contract method is used for tax purposes. So when we use the percentage of completion for financial purposes, we're going to be reporting revenue before we report it on the income tax return. So that's going to result in a deferred tax liability. The D states accelerated depreciation is used for tax purposes and the straight line method is used for financial reporting purposes for some equipment. So when this occurs, an accelerated depreciation method used for tax purposes, when straight line is used for financial, that will result in less deductions in the future or a deferred tax liability, which is 2. The E part states a landlord collects some rents in advance. Rents received are taxable in the period when they are received. So in this case, the rents are going to be taxable or on the tax return before they're going to be on the financial statement. So this is going to result in less taxes in the future. So that is a deferred tax asset. F states that there is tax-exempt income. So we know when there's tax-exempt income, that is 3, a permanent difference. G states that there is an SEC-related fine for financial reporting irregularities. So we know that fines are not deductible on the tax return, but they are deductible for financial purposes. So this is going to be, again, a permanent difference. H states that for financial reporting purposes, an estimated loss from a lawsuit is accrued. The tax return will not report a deduction until the amount is paid. So we know that when we report a deduction on the financial statements prior to reporting it on the tax return, this will result in a future deductible amount or deferred tax asset. I states a liability for a guarantee is accrued for financial reporting purposes. Again, this is going to be an amount that is going to be deducted on the financial statements prior to being deducted on the tax return. So this again will deduct in a future deductible amount or deferred tax asset. J states that their installment sales are accounted for by the accrual method for financial reporting purposes and the installment method for tax purposes. So we are reporting revenue on the financial statements prior to reporting them on the tax return. So this means that will be a future taxable amount or deferred tax liability. And that is the conclusion of the demonstration for exercise 19.6b.